There is a house. It is the right suburb, the right size, the right commute. The price is $750,000. The deposit question comes next, and that is where the evening starts to feel longer than it should. The advice is everywhere. Save 20% before you buy. That is the rule. On a property like this, 20% is a six-figure target. For a household paying rent, running normal expenses, and trying to save at the same time, that target can feel less like a goal and more like a sentence. If you are saving around $2,000 a month from zero, 20% takes around 4.5 years, assuming the property price does not move. In a suburb where prices have been rising, the target can shift faster than your savings. The question is whether this is actually the only path. By the end of this video, you will know the 3 realistic deposit options for Melbourne, which government schemes can change the maths for eligible buyers, and the one cost that surprises most first home buyers when they finally check the full settlement figure. What most people do not is that there are 3 deposit levels the lending system, not just one. 5, 10, and 20% each have a different cost profile, a different risk profile, and a different set of government schemes that can sit on top of them. Below 20%, most lenders add lender's mortgage insurance to the loan. It is not your insurance, it protects the lender if you default. It gets added to the loan balance rather than paid up front, but it does increase your loan size and your repayments from the first month. Here is the tension most people feel but rarely model. Waiting to save a larger deposit reduces the insurance cost, but if the suburb is appreciating steadily, the extra time spent saving can cost more in purchase price than the insurance it avoids. The maths does not always reward patience. 3 government schemes were designed specifically to improve the deposit equation for eligible buyers. 2 of them can remove the insurance cost on a 5% deposit entirely. One reduces your actual loan size by nearly a quarter. Understanding which one applies to your situation is the starting point. The First Home Guarantee is a federal scheme. If you qualify, the government guarantees 15% of your loan to the lender. You buy with a 5% deposit, no lender's mortgage insurance. On a Melbourne entry home, that removes a meaningful cost that would otherwise be added to your loan from day one. To qualify in 2026, Australian citizen or permanent resident, first home buyer, owner-occupier only. Income cap is $125,000 for singles, $200,000 for couples. Melbourne's price cap is $800,000. Places open on the 1st of July and are filled through participating lenders. They do not wait for you. The Victorian Homebuyer Fund is a state scheme with a different structure. The government co-purchases up to 25% of the property alongside you. You contribute 5%, they contribute 25%, and you borrow 70%. Your loan and your monthly repayments are significantly smaller. The trade-off is that the government holds a stake in your home. When you sell or buy them out, they take their proportional share of any growth. For buyers planning a long hold and wanting lower repayments in the early years when other costs are often highest, this can still work in there. The Victorian First Home Owner Grant is a $10,000 cash payment, but only for new homes or substantially renovated properties under $750,000. It does not apply to established homes. If you are building or buying off the plan, it can go directly toward your deposit pool. At 10%, the insurance cost drops to roughly half compared to 5% without a scheme. You also unlock a wider range of lenders and sharper interest rates. For buyers who cannot qualify for a guarantee scheme but cannot comfortably reach 20%, 10% is often the practical middle. This is a good place to pause. For your household right now, is the priority getting into the market sooner with a scheme at 5%, or saving a larger buffer so repayments feel more comfortable from day one? That answer shapes everything below. At 20%, there is no insurance cost, no equity partner, and access to every lender and the lowest rates. Monthly repayments start smaller and equity starts higher. The main reason most Melbourne first home buyer families do not aim here is the timeline, and in a rising market, that timeline has a real cost attached. Here is where most careful savers get caught out. They hit their deposit target and then find out they also need stamp duty. In Victoria, stamp duty on an established home at $750,000 is over $40,000. The first home buyer concession has fully phased out at that price. Add it all up. At a 5% deposit on a $750,000 Melbourne home, you need around $80,000 in accessible savings before the bank will proceed, not the deposit figure alone. The deposit is just the first line on the settlement statement. The first trap is common, saving toward the deposit percentage while forgetting the purchase costs. Stamp duty, conveyancing, the building inspection, and the loan establishment fee do not appear in most deposit calculators. Build the full target, deposit plus all costs, into your savings goal from day one. The second trap is treating the first home guarantee as guaranteed. There are 35,000 places nationally allocated through participating lenders from the 1st of July. They fill. If you plan to use this scheme, speak with a participating lender before the financial year opens, not after you have found a property. The third trap is dismissing the Victorian Homebuyer Fund because the government takes a share of your growth. For households with a genuine long hold who want lower early repayments, especially when other big expenses often cluster, the relief in those first years is worth modeling before ruling it out entirely. At $2,000 a month in a high-interest savings account, you reach a 5% deposit in around 18 months. 10% takes around 2 years and 9 months. Add your purchase costs on top of whichever threshold you are targeting. That full number is what your savings goal should match. 3 questions narrow the right option quickly. First, do you qualify for the first home guarantee? If yes, 5% with no insurance is usually the strongest entry for eligible buyers. Second, is your income rising? Paying the insurance now and refinancing when your equity grows can be the rational move. Third, what is your target suburb doing? If property values have been rising steadily, every extra month spent saving to avoid an insurance cost may cost more in purchase price than the insurance itself. The right answer changes as your savings grow and the market moves. Recalculate annually. The plan: set your full target first, deposit plus all purchase costs. Open a dedicated savings account and automate a transfer on payday. Check your scheme eligibility on the 1st of July each year when places reset. Get mortgage pre-approval early before you find the property you want to bid on. There is no single right deposit for every Melbourne household. There is the right deposit for your income, your timeline, and which scheme you are eligible for. The goal is not the most impressive target. It is the deposit that gets your household in and still lets it breathe once you are there. This is general information only. Your right option depends on your household, income, and goals. Before any deposit decision, speak with a licensed mortgage broker, conveyancer, and a financial advisor. Schemes and thresholds here are current for 2026. Check at the source before acting.